All right, let's get right to it. The market is coiled at a critical level. We're looking at either a major breakout or a classic bull trap. Here's the tactical plan for the next 1 to 2 weeks.
So the S&P 500 is right up against key resistance. This setup is pretty much binary. It's a make-or-break situation with huge potential on both sides. Let's break down the data and lay out the playbook. After that last Fed announcement, the index has just been sitting there, closing at 6,890.59. You can see it's coiled just below that 6,900 resistance level. This is the line in the sand. This is where bulls and bears are placing their bets.
Okay, there are 3 major external events pulling the strings on this market right now. Let's get straight to what's driving the macro picture.
The market is basically navigating a minefield this week. You've got the Fed's next move totally up in the air, a really high-stakes meeting between the US and China, and of course the clock is ticking on a potential government shutdown. This is a perfect recipe for volatility.
And here's the real conflict, the push and pull. On one side, you've got the Fed signaling easier money. They're ending quantitative tightening, shrinking their balance sheet, which is bullish for liquidity long-term. But on the other side, you have the very real threat of a government shutdown, which is a major drag on the economy. These two forces are literally pulling the market in opposite directions.
Now let's pop the hood and look at the engine. The market's own internal gauges, well, they're flashing some caution signals that we absolutely have to pay attention to.
First up, sentiment. It's getting pretty frothy out there. The latest Investors Intelligence survey shows a 44% spread between bulls and bears. Now, historically, when everyone gets on the same side of the boat like this, it's often a signal that the trade is crowded, and the risk of a sharp reversal is high.
Second, and I think this is even more critical, is this really clear divergence we're seeing in market volatility.
Okay, this is a big one. You need to pay attention to the action in the VIX, the market's so-called fear gauge. It's actually risen for 3 straight days, even while the S&P 500 was climbing. That's a classic divergence. It's a huge potential red flag. It tells us that the smart money is quietly buying protection, which means they don't fully trust this rally.
And finally, let's talk about market breadth. Think of this rally as a building. Right now, it's being held up by just a few massive pillars, the mega-cap tech stocks. But the foundation is weak because most other stocks, they're just not participating. That makes the whole structure pretty unstable and really vulnerable if those few big pillars start to crack.
So with all that context, here are the specific areas where these forces are creating both opportunity and risk.
All right, here's where the rubber meets the road. We're watching strong tech like Meta, which is testing that key support level near $700 after earnings. We're also keeping an eye on AI momentum names like Palantir. It's just a magnet for speculative options activity around that $200 strike. Over in industrials, Steel Dynamics is setting up for a potential breakout. And hey, if you want a pure play on geopolitical news, Chinese equities through the FXI ETF, that's the spot.
Before we jump into the specific scenarios, here's the mandatory and important disclaimer. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. You must do your own research. This is not financial advice.
Okay, let's move on and see how all this builds into 3 potential scenarios, and, more importantly, how you might posture for them tactically.
Our base case, the scenario with the highest probability, is that the market just keeps grinding higher, but with a lot of chop and volatility. We're assuming the macro news resolves without any major disasters. In this kind of environment, the posture is to stay invested but keep some dry powder. So 60% long delta, 25% in cash to buy the dips, and 15% in tactical hedges to navigate the choppiness.
Now for the bull case. If we get a positive surprise on the macro front, we can see a really powerful breakout. The key level to watch is 6,900. A clean, decisive move above that is the green light. The plan would be to increase long exposure to 80–90% delta with an initial target of 7,000.
And finally, the bear case. Look, if the macro news turns sour, the playbook is simple. Defense first. Cut risk down to 20% delta, or even less. Raise cash and add protection through puts or long volatility. In this scenario, capital preservation is the only thing that matters.
So the crucial point is how these scenarios translate into a clear bull and bear thesis for the market structure we're in right now. So here it is. The bull thesis is that this whole AI-driven boom is fundamentally sound, that it's resilient enough to just power through the current macro noise. The bear thesis, on the other hand, is that the rally is structurally fragile, supported by those poor internals we talked about, and a negative macro shock is the pin that's going to pop this bubble.
Given all this uncertainty, options can be a really useful tool for defining your risk. So let's look at a couple of potential setups just to illustrate how you might approach this market.
First up, a bullish setup on Meta platforms.
The thesis here is pretty straightforward. Meta is a strong company. It's pulled back to a key technical support level around $700. A call debit spread is a great way to play a potential bounce because it gives you that upside exposure, but it clearly defines your maximum risk. You know exactly what you stand to lose before you even enter the trade. The invalidation level is simple, a clean break below $700.
Second, a neutral, more range-bound setup on Palantir.
Okay, this one's a bit more advanced. It's based on market mechanics. There's a huge amount of options activity, what we call gamma, centered around the $200 strike in Palantir. This creates a kind of gravity that's likely to keep the stock pinned in a tight range, especially after earnings when implied volatility is expected to drop. That sets up a potential premium selling strategy like an iron condor, which profits if the stock just stays within a defined range.
So there you have it, a tactical look at a market that's really at a crossroads. And the final, mandatory point, this is not trading advice, just a market update to keep you informed. Markets carry risk, trade your plan, manage your downside, and verify all data. Stay disciplined out there.